Hi, I'm Ed Coyne, Executive Vice President and Head of National Sales for Sprott Asset Management. With me today is Trey Reik, Senior Portfolio Manager at Sprott. Trey, over the last couple years, more and more investors are looking to allocate capital away from traditional stocks and bonds and break the old 60-40 model. Where does gold fit into that model as far as thinking about gold as an alternative investment?
Well, I think to start simplistically, gold's great utility as a portfolio asset that is unmatched by other portfolio asset classes is that gold is relatively uncorrelated to everything else. So there are short periods of time where gold can be seen or is deemed to be in correlation with oil or equities or other asset classes, but those correlations are usually fairly short term, maybe 3 to 6 months. And over the long run, the only thing to which gold shows consistent correlation is its negative correlation to the US dollar. It's about negative 0.82. And that separates gold from almost every other asset class. Because of that non-correlating behavior, gold has been definitively shown to increase the returns of standard stock and bond portfolios over the long run, while decreasing standard deviation by 100 to 200 basis points, depending on the allocation. So if you're looking at this in sort of a return frontier sense, gold can provide similar returns to a portfolio that doesn't own gold with less risk, or with the same amount of risk undertaken, enriched returns over the long run. So because of that, an allocation to gold in, say, the 2 to 4% range passes the prudent man rule or test in almost any environment, including probate court. But that would be under normal circumstances, and I would suggest that our current environment, or in terms of monetary and political backdrop, is anything but ordinary.
Right.
So perhaps that allocation, rather than 2 to 4%, might be 5 to 10. But the other aspect of gold, in terms of portfolio utility, is one aspect that I think is most coveted by some of the shrewdest and most disciplined investors in the world, the Druckenmillers and Soroses of the world, and that is gold's ability to remove virtually unlimited amounts of investment capital from the financial system in an instant,
right,
in a fairly safe manner. So whether it's overvalued markets or an excess of debt or promiscuous central bank behavior, or even the financial system itself is of concern to any investor, gold offers the ability to move instantly large amounts of capital outside those perceived risks.
Wonderful, thank you. And what about then the catalyst, right? So everyone talks about gold and where it's trading today, and people love to focus on the price, right? Whether it's $1,200 an ounce, $1,250 an ounce, $1,300 an ounce, where is it trading that given day? And people sometimes tend to miss the objective of gold is to really perform differently than the markets. And so a lot of people tend to focus on the price, but what is the catalyst in your mind going forward on moving gold or allowing gold to really be that true diversifier in a portfolio?
This is one of my favorite questions because as a gold guy, I'm frequently asked, why isn't gold doing better?
Right.
Whether it's, a Cyprus event or Brexit or anything that comes to mind, there's generally this perception that gold should be doing better. And the irony is that over the past 17 years, nothing has done as well as gold. So gold literally is the best performing asset on the planet since 2000. And in the past 17 years, gold's advance not only has been large, but it's been very methodical. So in 14 of the past 17 years, gold has posted an annual increase when measured in dollars. And for 15 of the past 17 years, when measured in an average of the world's leading fiat currencies. So over that time period, there have been lots of different monetary and economic conditions, periods of inflationary concern, deflationary concern. There's been periods of rising and falling short and long rates. And along the way, gold has posted this sort of unparalleled consistency of positive returns. So there's obviously something going on there that's a little bit more overarching than I think most people give gold credit for. And what I believe is happening is that concern for sort of overissuance of credits on future output, a long-winded way of saying financial asset prices are very high versus underlying productive output. Each year, a small percentage of global financial assets, which measure now about 290 trillion, seeks a home, as I mentioned before, outside the financial system, or something that is a little safer than stocks and bonds. So if it's 0.1% per year that makes that migration, that would lead to this methodical progression. Mm-hmm. The whole gold thesis, in my opinion, is not about Armageddon or a dollar collapse or Weimar Republic runaway inflation. It's just about that rate of migration going from 0.1% in a given year to say 0.5%.
Okay.
Because 0.5% of 290 trillion, not to get too mathy, is about 1.45 trillion.
Right.
And that isn't going to make it into a gold stock of 2.6 trillion without a positive price dislocation. So I think gold is more about long-term protection from this mismatch of claims on future output as measured by stock and bond claims. And over time, not only does gold offer a resting place unlike stocks and bonds, which might correct, but it also protects you from the debasement of official policy response to try to ameliorate that mismatch between debt and underlying productive output. So in essence, the only way to sort of get out of our debt problems is default or debasement.
Right.
And gold is the only asset that is really immune to both. It can neither default nor be debased.
Well, it sounds like we have history on our side, right? The last decade and a half, gold's done very well as a diversifier, and on a total return basis, it's done quite nicely as well. So I think we've got history on our side. Looks like the market is sort of setting itself up for some continual volatility, and I think we're in a good position. Thank you for your time today, and thank you all for watching this video. Please visit us at Sprott.com to learn more about how Sprott can be your alternative. Thank you.